Hi, Vicki. How are you?
Oh,
Can you hear
pretty good.
me? Well, great to have you with us, Vicki. How have things been going? And good to have you here before the NFP. So we had some action out of, or inaction out of the BOE today, and the Euro Pound exploded on that. What's your view going into the NFP? The dollar's been on a bit of a run. Anything that could interrupt the run, or is the die cast with the Fed moving in December? What are your views in here?
Well, it looks like, I mean, to me, it seems like the Bank of England kind of threw a monkey wrench into everyone's thinking today. As if the Fed didn't learn its lesson about not necessarily you may have concerns about things outside of your your own country, but maybe it's not always good to mention them. And certainly today, the BOA's mention, Carney's mention of emerging market, potential negative spillover effects, that got the market nervous again, just as when the Fed did that a few months ago, we
Good
had the
point.
same sort of reaction. So I think that, I mean, obviously today we've seen, a lot of squaring of euro sterling shorts. That was like the favored trade. And yet, you get to the point where, sterling right now that looks like it won't go below 152. And at the same time, I'm just looking, make sure that it hasn't moved since I was last looking. But for the euro, it seems that the market's favored play has been to go long dollars against the euro. So we've
Yes.
come from about 115 down to almost 108, almost back to the July lows around, I think it was 108.09, something like that. And you have to say to yourself, heading into tomorrow's non-farm payroll, is it worth pushing the trend? I mean, have we perhaps already gone as far as we can go based on the ideas, okay, we'll have a December Fed liftoff and further ECB easing in December, and that's what the market's been thinking, and that's got us down here. But until these things actually come to fruition, should we really be taking the euro below 108? And I mean, most of the people that I've been speaking with in the last few weeks have had like this sort of 108.50 to 108 as their target, but
Right.
feel, I mean, even tomorrow's number is going to have to be a really knock your socks off number for a decisive break of 108. I mean, we may go down and get on a 107 handle, but it's going to be hard for the euro to keep moving lower unless we have, all of the dominoes lining up in terms of we're at 175 for non-farm payrolls. That's M&I's median estimate, and I think they're looking for
Okay.
5% and plus zero point 0.2 for average hourly earnings. And then we'll have to look at the participation rate, backward revisions, all of those things. But all the dominoes are going to have to line up to get that euro below 108 on a sustained basis.
Well,
And
let me ask you
otherwise,
this.
sure.
Let me ask you this. If we're the market's kind of short, too short euro right now, and say for example, I believe the average guess is 180 and whisper numbers of 200. Say we get your number lower, what kind of recovery would you be expecting in the euro from this 108, 107 handle?
Well, what I find interesting is heading into today, the market was very much believers. Like they wanted to believe that the world was going to be a rosier place. And had the Bank of England, they were disappointed that it was, that there was only one person voting for a hike instead of two. They were hoping that you might see that. But just the Bank of England's comments were a little downbeat. And that took some of the steam out of the market's rah-rah feeling. And so tomorrow, I think that the market really wants that number to be a good number. Now, what is a good number? So if I would say up until yesterday, it could have been even 125,000 if all the other, dominoes were okay and not showing sluggishness. And I think the market still would have taken our yields higher and maybe even the dollar higher, certainly dollar yen higher. But now I think the market is just, well, like the BOE burst our bubble a little bit. What if tomorrow's number bursts our bubble also? So the market's hopeful that that number is going to be a good number, that the non-farm payroll headline and all the other components are going to be good. But the trouble is we've just been disappointed so many times. So I'm now thinking that if it comes in between, under 150, let's say, you're going to see some dollar selling, and that should get the euro. I mean, people keep telling me that all the rallies are going to be sold, and so if we start getting, I think the market will try selling it as we get maybe in the 109, 25, 50 range, but they really would rather sell it closer to 110.
Okay, so 110 is going to be a level where should we get a weak number and the dollar comes off, that the euro should find some trouble.
Yeah.
Any view on what's happening with commodity currencies? They're pretty confusing. We've had a decent move in energy that took Canada down. Now Canada's trying to recover. Gold has gotten pummeled since the whisper of a potential on the hawkish statement by the Fed. Any view on what's happening here in Aussie and what's happening in Canada?
Well, I mean, I think it boils down to the dollar and China. I mean, that's what it boils down to for all of it, whether it's in gold's case, the market, again, keeps getting hopeful that, oh, this is going to be the time that gold finally rallies, and then it breaks a key, tech levels to the top side, and the market loads up long, and then they get their fingers slapped again, and that's what's happened in the last few days. So, gold now is probably, run its course, and we might get a little bit lower, but it's gonna take, again, a big, strong dollar up move to send gold much below, I think, 1100 right now. And as for commodities as a whole, again, we have this sense that now that we know China is going to be at least purportedly growing around 6.5%, that's a little bit better than maybe the market's worst fears. So they're going to be watching Chinese data very carefully, but that gave a little bit of, commodities need a global economic recovery in order for commodity prices to really see a sustained move higher. And that's the same for the for the commodity currencies. That 1 minute Canada's looking very, you see oil pushing higher and the loonie starts rising. And
so maybe the BOE was right to be a dove with the action in gold. Gold dropping here is a bit deflationary, so perhaps the dovishness is appropriate, and possibly a Fed tightening is not appropriate, and possibly giving in to the right-wing faction of the Fed that wants to see rates rise, whether or not there's economic justification or not.
Well, I think it's really hard to be a central banker right now, because on one hand, you want to tell it the way it is, but the trouble is when you look at like the BOE and the Fed, but the Fed especially, as being the adults, the only adults in the room at the moment. And they're the ones that if they say, oh, we're upset and we're scared about something, then the whole rest of the world starts to be scared about it. So there's that fine line. I mean, you've seen recently that, just yesterday, both Yellen and Dudley were saying that the December meeting is live. And I think you have to keep that carrot dangling in front of the market if you want the market to at least have a degree of risk appetite. And I think that balance between risk appetite and risk aversion is really key, because when shoes start dropping, the market's really quick to start, just like in trading places, sell, see more, sell. The market's really keen to do that. And it's harder to keep the market in that sort of rah-rah phase.
To me, it seems like the Fed is a dove when the equity market is under pressure. So they're probably selling puts, and then we have a recovery in the S&Ps into the next Fed meeting, and that's why I thought there could be a somewhat more hawkish statement because of financial market conditions. They probably were selling calls up there. So is it possible that the market is leaning the wrong way and that the Fed does nothing in December?
Well, and I guess it depends on what what the market's really positioned for. I mean, we seem like we go in one direction and say, oh no, the Fed's not going to raise rates in December, and then, oh, now the Fed's going to raise rates in December. So yes, of course we could be disappointed again, and they don't do it in December. But we've got two non-farm payroll numbers, and people seem to forget that we're going to have another one coming in December also. But I think if tomorrow's number is a good number, that will be December's would have to be a really December's release would have to be a really spotty number for the Fed probably not to act. But again, there's who knows what's going to be happening in China, in the Eurozone. There are lots of other things going on out there that can that could give the Fed pause.
Do you think it's possible? And I know that they have in the past, vis-a-vis Plaza Accord, etc., that the reason the BOJ did nothing is because they got a call from the U.S. Fed that really doesn't want to see 125 U.S. dollar yen in a heartbeat, that they're going to help both Japan get what they want and Draghi get what they want with an interest rate increase, but the speed and velocity of that move is more important than the direction of the move.
Yeah, no, I mean, central bankers certainly all speak with each other. I mean, that's not a surprise. And it certainly wouldn't be a surprise to have them discuss foreign exchange rates as well. But the speakers have all stressed that this is just one thing that they're looking at. And they're looking at, the volatility in the market. They're looking at risk appetite in the market. They're looking at, a wide array of issues that are taking place. And so I still think you're right in terms of it being, it's the speed of the move. The BOJ, I mean, there was really mixed views about whether they would do something in October. And now it seems much more likely that we'll see the ECB and the BOJ announcing something in December. In a sense, if the Fed really looks like it's going to be raising rates, it makes the BOJ and ECB's job a little bit easier, because the only way the Fed's going to be raising rates is if it looks like the global economy is on. I mean, obviously our economy is on track, but also that the global economy is on track. So it means that what the BOJ and the ECB it looks like they will be announcing something in December, but they may not have to use all their bullets or have as much of new easing as if we do nothing and it looks like the global economy is heading south.
Could it also be that the Fed tightening, should it do it, is not as much about economic conditions, but the lack of tools that it now has to respond to any exogenous shock from the financial world?
Well, they will argue, and they have argued, that they have plenty of tools to deal with whatever happens. The next thing I'm actually looking at is we've got Chinese reserve data coming out. I mean, I think M&I has it penciled in for November 7th, but reserves are expected out in the next couple days, and I think they're looking for maybe another 50 billion decline in reserves. And if for some reason there's a surprise in that reserve data, the market might react to that too, because it's this idea, is China indeed either paring back the buying of U.S. treasuries and or outright selling of treasuries? So that may be another little wild card just to watch out for, because once we get non-farm payroll under our belt, it's going to be a long wait until December.
Okay, so November 7th, Chinese reserves are out.
Well, I mean, they never announced the date exactly, so that's when we're thinking it should come out. Okay,
Vicki. It's been great talking to you today. Yep. What's the best way for people to follow your work and your company and keep in touch with your views on FX?
Well, my Twitter handle is MNI for Market News International, MNI, and then I on FX, EYE on FX. And then the website is marketnews.com, www.marketnews.com.
Okay,